investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And I've left my lines on the chart like I do each and every week so you can see how the forecast worked out. And as I zoom in, you will see that the diamond started to pull back Monday, Tuesday, Wednesday, Thursday. You see, as I zoom in there, you'll see that we had lower lows right up until Thursday, and even on Thursday we had a bearish engulfing pattern. So it looked as though we were going to go lower until today happened. And that's when the good news of the China-US potential deal coming through, or at least partially coming through, and the market reacted with buying action coming in. So now we have a bullish engulfing pattern. So the market has turned 180 degrees in just one day. And so what does that mean for next week? Well, I believe that that bullish engulfing pattern is going to pan out to the higher levels. And if you look right here, the highs from September are going to be our newest resistance point. Now, I mentioned this last week. You'll see this long shadow was a misprint. They never removed that misprint, so it showed up as a long shadow on the charts. But that's a false high. So we are expecting now to go higher and possibly break out of that existing high resistance. So if you are taking any long positions, I would strongly recommend that you watch the downside, because there's still a gap below the market here. And that gap fill point will act as support, but there's always an 80% chance that gaps will fill. So if you're taking any long positions, it would be a good idea to use trailing stops or some protective risk management level, whether it be options. Don't trade options until you know what you're doing there, but at least trailing stops or a price alert. If it starts breaking down below that support, then we could expect the market to hit that secondary support level. Look at the CCI down here. It's hinging up, and that is a sign that the momentum is shifting higher. Now let's take a quick look at the VIX, which is inversely related to the S&P 500. But last week I said the VIX would rally. It started to do that, and it looks now as though we're going to go right back down and test these lows. So my forecast for next week is that the VIX is going to move lower just like that and possibly bounce later in the week. Now, if we bounce, remember it's inversely related to the S&P, that could be bearish. So you have to keep your eyes on the VIX as a leading indicator, because there's an open gap above the market, and 100% of the gaps fill on the VIX because it's an oscillating indicator. It's not a trending stock. So make sure you use that as a risk management tool. Now let's hop right to the SPY. S&P 500 is going to look just the opposite and very similar to the Dow. But we had a bullish engulfing pattern right here on a fill of that gap. And what I think we're going to see next week for the spiders is I think we're going to break out into new high territory right there. And again, the CCI is hinging higher. The stochastics almost gave a sell signal, but it's starting to hinge up again. So I'm going to raise this line. We'll keep that in mind later on when the market starts to pull back. That gap is going to be a price target eventually. But right now, for the short term, I think the S&P is going to break out and set new highs next week. So that's going to be very interesting, especially as we track the news coming from the US-China trade deal. Now let's look at a more broad-based index. That's the Russell 2000. Last week I said it would pull back. It did not. Again, 180-degree reversal in the shift in the momentum, where yesterday we had a bearish engulfing pattern followed by a bullish engulfing pattern. And again, the CCI is starting to hinge up. So what does that mean for the Russell 2000? We're probably going to go higher. And I'm going to put a 2-week forecast on there that we're most likely going to test that high. Now, as we end the month of October, we're starting to get into the holiday season, and there's a cycle that we need to pay very close attention to, and that's the year-end rally, aka the Santa Claus rally. So this might be a premature initiation of that rally, as investors and traders start to get a little bit more optimistic of this trade deal, it could continue higher and eventually add to that upside momentum. Now let's take a look at the Qs. That's the Nasdaq market, QQQ. Bullish engulfing pattern again, and we had lower lows right up until Wednesday, and then it shifted. That gap is still going to remain open for now, but eventually that could fill. And I'm going to have to condense my price action here because if you notice, the volume is increasing on the last 3 days. So I think the Nasdaq, like the other markets, are going to reach for that high and possibly break out of that high because we close right at resistance. So my forecast is going to look just like that. I'm going to go 5 days out and put a price target right at the end of that trend line right there. Now, I have been analyzing OUSA, which is the OShares. That's Kevin O'Leary's ETF. I said that it would go lower. Again, just like the general market, we had a turnaround this week on Friday here. This is a harami that's bullish. So I think the OShares are going to break out of that resistance, go higher, but eventually I think it's going to pull back later in the week. Again, that open gap is going to remain that way until obviously it closes, and then that will act as a support level later on. Now, be sure to go to the Market Guys website, click on the video tab right at the top, and I want to guide you right to the 1% rule, which in my opinion is the most important video on this whole page. Learn how to manage risk, especially as the markets heat up in volatility. It's really important that you learn how not to lose a lot of money when you're wrong, but accept the fact that when you lose, it should be a little bit, and that way you're preserving your buying power. We call that the war chest, and then you can get right back into the market and hop in on the technical signals. So that's it for this week. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.